It was this time 3 years ago when the Reserve Bank slashed interest rates to stave off a recession in the face of a global financial crisis. The prospect of rate cuts is once again on the agenda, as the RBA board admitted it may have to act if global conditions get worse and inflation remains in check. The signal sent the Australian dollar lower despite some of the best trade numbers on record. Here's Philip Lasker.
As Europe fiddles, global growth burns, and the Reserve Bank might have to protect Australia from a scalding.
Certainly right here, right now, the RBA looks like their discussion is whether to cut rates or leave them on hold, and that's a big shift.
The RBA board opted to keep rates at 4.75% for an 11th month, and 2 months ago higher interest rates were still an option. But today's statement noted the increased uncertainty surrounding Europe's debt problems, softer world growth and the potential damage to confidence and spending everywhere. So if things get worse and inflation isn't a problem, the board says it would increase the scope for interest rates to provide some support to demand should that prove necessary.
If we get any further weakening in the domestic economy, any further signs of this financial uncertainty in Europe is affecting the Asian economy or commodity prices, then they can possibly ease before Christmas.
They will need more evidence to go. I think it's much more likely that they'll be cutting rates at the start of next year, because I think it would take time for that evidence to accumulate.
The evidence on the trade front was encouraging, with Australia recording a bumper trade surplus of more than $3 billion in August. Exports surged 8%, reflecting the return of coal exports from flood-hit Queensland.
The trade surplus right now is looking fantastic. We're exporting strongly. We're actually importing quite strongly as well, which reflects reasonable demand in the economy right now. But monetary policy is set for where the economy will be next year. And of course, these financial disruptions coming out of Europe will affect the economy next year.
Global growth fears and the effect on Asia and commodity prices were reflected in the Australian dollar today, which dived below 95 US cents to a 12-month low.
There's been a big change in expectations about Australia's outlook over the last 6 months, and that's coincided with the currency going from about 110 down to about 95 today.
It also coincides with a lack of decisive action from a divided Europe. EU ministers are now discussing boosting the rescue fund, called the EFSF, as Greece falls short of its commitments and edges closer to default.
We had no one advocating a default for Greece. Everything will be done to avoid that, and it will be avoided.
We are reviewing options of optimizing the use of the EFSF in order to have more out of it and make it more effective as a financial firewall to contain contagion in the financial markets.
We don't want to increase the capacity of EFS.
And that's not a situation that inspires confidence.